Travel lanes are opening. What can you invest to profit from all these changes? Now, if you have followed this channel, you kind of know I'm a big fan of being against SIA. But today, after this news, SIA share price has shot up yet again. Truth be told, I actually have a position called SIA 5X short. That's a DLC. My first attempt in understanding this product, and I picked SIA to be against. And it's so bad right now that I don't even want to look at it even further. So I don't know the markets fully. It's just reinforcement. No, markets are very humbling. How it reacts to a situation, we can never know for sure. We can only follow the right investment principles. I believe SIA is overvalued, but I'm wrong so far. But that's not the biggest takeaway from today's video. I have findings to share with you to give you some insights what you can potentially invest into for yourself. So if you're keen, I have actually 10 names that might interest you, and stay on for it. Number 1 on today's list is obviously SATS, something that I've mentioned much more favorably than SIA. Very simple terms, SATS gives you the same proxy to the whole travel industry. SATS is service-based. The assets they own include the gateway service, include cargo handling. They do not own the aeroplanes, which means avoiding depreciation and all this kind of nonsense when it comes to proper investments. So if you're really keen on aviation industry, you believe that more travel lanes will open, more tourists will come to Singapore, buy SATS. It's much better and ideal. The correlation to SIA is strong, but yet the company is much more sound. Quick update, CEO Alex Hungate will be leaving SATS as of December 2021, and he's actually joining Grab. And I'm keen to see how the cruise industry shows in terms of performance in the coming quarters. So if you're keen to find out more about SATS, look for a link below, which is a full tutorial I've covered before on SATS. I thought hard about who to be on number 2 on today's list, and I've chosen someone. And I've chosen someone to shock you because this company is indeed very cheap. But as I've always said on this channel, cheap does not equal to buy now. But cheap is cheap. We have to acknowledge that. Let's look at proper metrics like EV over EBITDA. EV is enterprise value, and EBITDA is actually earnings before interest, taxes, depreciation, and amortization. So this is actually how financial markets can measure a company. So based on this matrix, you realize that Comfortdelgro is the cheapest across all STI components, trading right now at 5.22 times EV over EBITDA. And why has that happened? It's because Comfortdelgro's share has came down significantly over the last 1 year. Whether it's justifiable or not, let me give you some more insights to it. I'm not a big fan of Comfortdelgro, so I mentioned it's much easier to buy SBS Transit or buy Viacom. These are easier businesses to understand, but Comfortdelgro has something that is very interesting, that is a proxy to this whole travel industry opening up, which is actually in taxis. If you look closely at this, you realize that taxis have been the biggest drag, correct? Simply because we know Comfortdelgro has extended rental rebates to all the taxi uncles we have in Singapore. And nowadays, in the younger generation, millennials, Gen Z, who takes taxis? Not many, right? We all take Grab, correct? It's only tourists that use the taxis. And if you can imagine US tourists, Europe tourists coming to Singapore, they would be queuing up at Singapore Changi Airport, taking uncle taxis right down to Chinatown. So Comfortdelgro is something that's been asked before in the comment sections. And if you're keen also, do leave in the comment section that you would like to see a full review on Comfortdelgro, because I think they have new things coming up that could impact my overview of how this share will perform in the coming months ahead. Number 3 on today's list is actually a very simple play and very unexpected one also. So I'll just give an overview picture of this company, which you definitely know, and that is Starhub. Why in the world is Starhub going to benefit when travel industry opens? If you look at Starhub's books, especially on their internet services, you realize that tourists, they actually buy roaming services from Starhub or any telco for let's say. But Singtel is exposed globally, so this whole change doesn't really impact it. M1 is privatized under Keppel already, so Starhub is the only proxy that's going to benefit a little when tourists come to Singapore and subscribe plans with them. And in that case, Starhub has actually done some recent mergers with MyRepublic, with acquisition of 50.1% stake in their broadband services. I know telcos are not very exciting, but if you look in terms of an investment perspective, you realize that once a company comes down for a significantly long period of time and that there's a lot of depression, usually the risk is sucked out already, and it's not difficult to see gains when they start performing better operationally. Number 4 on today's list is a company that's not listed in Singapore, ticker LVS. If you've been trading on US stocks, you kind of know Las Vegas Corp is actually a company that would benefit also from this whole reopening process, simply because they own MBS. Now, MBS is so iconic. I'm sure each and every tourist, when they come to Singapore, they will go to MBS. It's a no-brainer. They're not going to the zoo. They're going to MBS to see this fantastic architecture. But MBS, if you like to invest through LVS, this sticker, you realize that it's just part of their many, many casinos worldwide. They have casinos in Vegas, they have casinos in Macau. So the increased performance from MBS may not contribute significantly to LVS, but I'd just like to highlight to you how you can actually look in terms of an investment perspective. Maybe Macau is going to open up also, then that will be a time that LVS starts to get under my radar. I have prepared for you number 5, 6, 7 as REITs that are in the hospitality sector. Now these companies, they own properties, correct? In any case, I think it's much better to own properties than an aeroplane. Aeroplane depreciates. Airplane, we don't know what kind of changes that are going to happen in terms of the sector. But properties, hotels are there to stay. And if you're not familiar, then this segment is going to help you. These 3 names keep in view. First one, CDL Hospitality Trust. CDL Hospitality Trust is quite global, but the bulk is in Singapore. These hotels, I'm sure you have seen them before. Grand Coptham Waterfront Hotel, I've been to some of my friends' wedding over there. And also this one, W Hotel in Sentosa Cove. I love Sentosa Cove. And just a shout out, they have actually now free entrance. If you like to visit Sentosa, no need fees, just drive. You can actually go and check it out, W Hotel in Sentosa. The second is actually Ascott Residences. I like Ascott a lot more. If you're keen to find out my perspective on them, leave them in the comment sections. I think the search volume is not that high, but I'm big on them much more than CDL. Simply because they have hotels all over the world, and I think Europe is opening up way faster than in Singapore. The third is Far East Hospitality, which is back in Singapore. And brands like Oasia and Village Hotel, I'm sure you've seen some of the deals in Klook and stuff. So if you're keen on owning hotels, very simple, just buy a hospitality REIT. Number 8 and 9 on today's list owns assets near to MBS. Take a guess. What is it? The first one obviously is Marina Square. Marina Square is owned by UOL Group. And Marina Square, the neighbouring plots of hotels are all belonging to UOL also, which includes Park Hotel and Pan Pacific. So these are top 5-star hotels that will definitely see traffic, especially when some guests don't want to stay in MBS. And number 9 in today's list is the iconic thing right beside MBS. And I guess you're thinking I'm going to say that, so I actually held that back. Number 9 is actually Straco, which owns the Singapore Flyer. Now Singapore Flyer, if I'm not wrong, is still not moving, correct? When I drive by Shears, I don't see it operating. I hope they do operate soon. Straco, in my opinion, is a well-run company. It's just that the assets, especially the Singapore Flyer, has not been operating that much, which drags down the performance. They own aquariums in Shanghai. I don't know how well they are doing. I haven't seen latest numbers. But I think the Singapore operations might pick up, especially with more tourists coming on board. Singaporeans, we are not going to take the Singapore Flyer that much, unless it's Valentine's, we are doing a dinner over there. But tourists, I'm sure, are interested in the Singapore Eye. And that's why I believe if operations start to move, Straco could see good operational numbers in 2022. Number 10 on today's list, last but not least, is Genting, the king of hospitality, in my opinion, the only worthy rival of MBS. Genting owns casinos, but more than that, they also own the theme park, which I'm sure if you're in Singapore, you kind of know. USS, if you have a kid, you have to bring them there, correct? But Genting, as a sidetrack, they lost out on the Yokohama IR bid. I have been tracking them quite a bit, and on the members channel, I mentioned that they could become on the falling knife. But luckily with this news, they have sprung up already in terms of share price and hopefully also in sentiment. I'm thinking of doing an update on Genting soon. If you're keen, leave in the comment section so I know that feedback from you. And in case you haven't seen my full tutorial on Genting, let me invite you there, because there is broken down how Genting is going to morph moving forward into 2022. How they're going to benefit, especially when tourists are going to come back into Singapore full force. So with that, I'll sign off and see you there. Take care and goodbye.